We're doing what we would call position sizing, which means we're going to put our toe in the water. And if the water tells us we're wrong, what do?
We just build upon it. Or if it tells us we're wrong, we get the heck out.
Yeah.
That our goal is to build upon the entry. And if it does go the other way, if we're wrong, get the heck out of Dodge.
Welcome to the Up Your Average podcast, where Keith and Doug give no-nonsense advice to level up your life. So buckle up and listen closely to Up Your Average.
Good morning, Doug.
What's up?
This is being recorded, in case you didn't know.
Okay, welcome everyone. Welcome to the recording.
It's that time of the year that Gimbal is getting more foot traffic out in front of us here. We've got the flowers out. It's a beautiful time to be alive and in Carmel, Indiana.
It's really fun to have an office here. Nothing against all other offices, but an office in a neighborhood it's just fun to be a part of a neighborhood, fun to be a part of a community.
I had a trip with my daughter to Chicago earlier this week, and we had a lunch meeting in a neighborhood, and it was kind of fun. It was a fun little location. So
yeah, if any of you want to have lunch in the neighborhood, Keith will take you out to lunch in our neighborhood.
Man, there's a handful of places that are really good. So just let me know, and we'll make that happen. We will make that happen. Well, Doug, I thought we would just do today's show on how to help people understand what it is we're doing behind the scenes.
Yeah, cool.
There's when I was working at Texas Instruments and they were trying to explain high technology to me, a lot of times they would just describe, Keith, this is a black box. There's magic going on inside the black box, and here's the input, and here's what we want to come out of it. And then if we wanted to go down in the weeds and figure out what was going on inside the black box, that's where I'd go sit in the library kind of thing at Texas Instruments and put my thinking cap on and understand. And so this is kind of what's going on in the black box day, I think.
It's interesting that you use the term black box, because as I was thinking about this topic, I was thinking about another description that was used early on in my career to learn about position sizing, and it was the Morningstar style box.
Oh.
And the Morningstar style box basically just says there's 9 areas to put your money: large cap growth, large cap value, mid cap growth, mid cap value, so on and so on. And that I really never thought much beyond classically taught asset allocation until the last several years, where we've been learning about position sizing, when to buy and when to sell.
Well, we're going to go high tech today, Doug. We're just going to use the old school PowerPoint to kind of talk us through this a little bit. And
yeah, thanks to Caleb putting this together for you and sharing it with me. I really appreciated the thoughts just to help us think through today.
Right. And so normally when you're talking asset allocation, I think that's just maybe modern portfolio theory is a word of it. And that what we do is the example we showed for you all today is just 3 different asset classes. But mostly if you get a modern asset allocation portfolio, what do you think? 10 holdings in a portfolio?
Maybe. I mean, when we've had assets transferring here, there could be 50 to 100 different stocks or ETFs coming in. So I think there's a lot of diversification going on.
Right. And so asset allocation, conceptually, I think the Certified Financial Planning Organization kind of endorses it as the way to go.
Yeah, I spent some time this morning on their website just thinking about our talk today. And I think they do a good job creating a foundation, a platform. It's just going beyond. There's not a lot of thinking beyond what they offer.
Right. And that's basically an academic situation. Yeah. That's not necessarily a practical real world experience. It's this is what we've learned in academic world, and here we go.
Yeah.
And so as we're thinking about this and considering it, it's definitely endorsed by the academic world to be an asset allocator. And normally what would happen in that scenario is they would then maybe once a quarter, once a half year or annually, just take your original percentages you had in those and just rebalance it.
Yeah, that's the thing they're really focused on is rebalancing. And so when you have an asset class, let's say a large cap growth fund that might own Apple, Amazon, Netflix, Google, Walmart, Home Depot, when that outperforms, they would say, okay, take some off the table and shift that over to the one that performed the least. And so maybe you're moving it over to an international growth fund or something like that. So the rebalancing is the strategy. The influencers inside the boxes really don't change much as far as who they are.
So what that does, it may look like when we're building a portfolio, it may look like we're asset allocating, but we're really not. We're doing what we would call position sizing, which means we're going to put our toe in the water. And if the water tells us we're wrong, what do?
We just build upon it. Or if it tells us we're wrong, we get the heck out.
Yeah.
But our goal is to build upon the entry. And if it does go the other way, if we're wrong, we get the heck out of Dodge.
Yeah. And so why this is different than asset allocation is asset allocation will put more money in the ones that are going down, right?
Yeah.
And they're just going to keep their fingers crossed that it's going to come back up.
With the belief that modern portfolio theory that, everything is known out there and everything's reasonable and it will come back and, all this stuff. And we just don't believe that.
Right. And so we're going to act pretty much opposite of asset allocation, even though it may look exactly like it, right? It may.
Yeah, because the investor on the other end of the line, whether they went to Dartmouth or whether they, didn't go to Dartmouth, there's fear and greed out there motivating decisions.
Absolutely. And so I think that's the importance of today's conversation is that you may be looking at your portfolio and thinking we're doing asset allocation, but it's something completely different than that. And so let's go back to this beautiful screen here. And so this we had just a wonderful conversation with our friend Stan Weinstein a couple weeks ago, and it's out there on our podcast. If you haven't watched it, we'd encourage you to take a look at that. But this kind of wave that's here is what he termed price stages. You have price stage 1, 2, 3, and 4, and pretty much you can go to about any stock and see something similar to this, or any market and see where are we at. So the idea is when a market or a ETF or a mutual fund or anything is trading sideways, then you don't really need to be trading in it. If it's just going up and down and up and down, you're losing time.
Yeah.
And time is money. I don't know if that was Benjamin Franklin who said that or whoever said it, but to go sideways is you've got that money at risk and you're not making progress.
Yeah, which is tough, especially when even something as basic as a money market will pay close to 4.
Absolutely. And so when we're going into position sizings, what will happen is our position size in a money market may go up depending on where these stages are in the different investments.
Which is a wild concept. The asset allocators would never say to do that.
Right. And so what we're watching behind the scenes for you is the stage 1. And what a stage 1 looks like is it's riding down the slide. The metal slide at the local park is the downslope, and then it flattens out over here. And we're watching those to see when they quit moving sideways. And that's when we want to go into them.
I love looking at stage 1 stocks. Do you?
I do.
I do. And I really like it because I think it's a hopeful place to start. I know hope's not an investment strategy, but when you're looking at stage 1, you're seeing potential opportunity ahead.
And it basically is just, it's zigging and zagging and zigging and zagging. And what Mark Minervini calls it is a volatility contraction pattern. So that sideways movement when it first comes down the slide of the stage 4 it's a lot more volatile because some bad news has happened. And see if I can show you an example of one of those that happened this last few.
So when the bad news becomes less and less and less and less of a factor, that's when it starts to become a little more attractive.
Yeah, let's look at this one. This is a bad deal right here. Yeah, so this right here, if you're watching this instead of just listening to it, you would say this might be a stage 1 right here. It's banging up and down, up and down.
It's trading within a base is what we call it.
Yeah.
It's got a top line and a bottom.
Yeah, and in that range, we don't want to own it in there because it's going nowhere. It's just going sideways, and eventually, yeah, that's almost what is that? That's almost 180 days right there that it just was going sideways, and we didn't know which way it was going to come out of there. This wasn't one we were actually going to buy for anybody, but it came out right here and told us, well, this is probably a stage 4. This is not going into stage 2. It's probably going into stage 4. It's dropping out the bottom. A lot of times stage 4s will drop below this black line, the 200-day moving average. And so it came below that, and then it set another range right about here between the 200-day moving average and the this a new low section it set here, and then boom, it came down again below it, and then it kept going down below it. And so
what is the relative strength? So relative strength means like relatives to the S&P 500. How's this doing? Is that a 5?
Yeah, 5. So it's
outperforming 5% of the S&P 500.
Yeah, and it had down below here. These numbers right here are the dividends. So it was paying $8.40 in dividends
the whole time.
But it dropped from $631 a share all the way down to, I don't know what it hit yesterday, 150 maybe. No, that's 250 maybe. So that's a painful drop, and so that's just an extreme example to show you of what a stage 4 looks like, because we don't want to be holding stage 4s.
Right.
Yeah, and so a stage 4 starts when it drops below that stage 3 level. That could be a stage 1 or 3. They could be very similar. If we watch successful stocks, they keep stair stepping up, and so the next stage 1 may look like a stage 3 there. So
that's a beautiful chart.
So as we're watching the price stages, it's just driving our decision grid, right? And we want to be right all the time, don't we? Yeah. But what we want is this section right here. We want this stretch, the straightaway, like it's race month in Indianapolis, and the straightaway is where you get the speed, and the turns you got to slow down. And so when things are turning, we're slowing down and watching them. But we definitely want to
get from 1 to 2. I mean, there's a critical mass that takes place.
Yeah.
And sometimes it goes the other way. And so like you had asked me earlier, what do you do? Well, that position size, you cut it when it goes the other way, and it doesn't hit the positive force into 2 like you'd want it to.
Yeah. And we put this publication together for you all years ago, Financial Survivors, a guide for living before loss. And I was just thinking as I was preparing, there's a paragraph in here that says, encourage your heirs to avoid the temptation of attaching sentimental value to investments. Investments are designed to help the owner grow wealth. Individual stocks have a tendency to evoke more sentimental ties than other investments. People don't get tied to exchange traded funds, but William O'Neill told us all stocks are risky. So any stock can transform from a stage 3 to a 4 in a heartbeat, just like that United Healthcare that we just showed. That
or
was
any ETF, or
anything can,
or any mutual fund. Maybe you love the Magellan fund your whole life. I don't know.
The same principle is true with any asset class. Really, your house will do it. Yeah, a house. They'll all do these things. So to lock somebody into owning a thing because you had sentimental ties to it could really risk your family wealth because of this whole process. It's just supply and demand is all it is. Well, let's take a look at the next idea. So we're looking at stages, and then we're looking at position sizes. And the idea of a position size, I'm just showing $100,000 account that you might have, is that if you put more money in your account, you can use those stages to help you in the decision grid, but you've got to put something in there to limit it. So the 100,000, if you put 33,000 in there and you had a 10% drop, that's going to have a substantial impact. It's going to be a 3.33% drop on your overall account. And so what a lot of times will happen is people will diversify with something like 20 positions. And that makes sense if you're not strategically watching what stage you're in. But if you think that you've got an edge or an advantage, you want your position sizers to be larger so that you can actually make money when you're right. And this idea is not that prevalent in our industry these days, I don't think. I think people are just getting more towards the 20 position sizes so that you don't really see that you're wrong. And so this idea, I think, is kind of important to understand when you're looking at what risks that you're taking. Do you want to take a stab at explaining this to our friends, Doug?
Let's see here. So you're talking about if you had 100,000 invested, what is that risk?
Right.
Yeah. And so by investing in a discipline where you have some stop losses, you can determine what your risk is before you even buy something, instead of just being at the mercy of the stock market.
Absolutely. And so I used to think that if I put $100,000 in something, I was risking 100,000. And it could happen. Like somebody could go, you could buy a stock that's a scam and tomorrow morning you wake up and it's zero. That happens.
Yeah.
It's pretty far and few between, those occurring. But when we say, for an example, if we went into a stage 2 stock, we're going into it with a stop loss in mind.
Yeah.
So if we put a 10% position in place, say out of this 100,000, if we put 10,000 in, we're probably not going to let that drop 10%. Probably not, but that's 10% of 10,000 is $1,000. And so in that example, what we're intending to risk is not the 100,000, 1,000 of the 100,000 in that example.
So looking at it from the math perspective really helps, because if you don't, the other perspective you have to look at it is, well, you liked technology stocks a week ago. What causes you not to like them 7 days in advance? Like why change your mind? Why don't you like this when you did like it last week? Well, the reason why is the math. It's not the asset class itself or the specific stock itself. It's just math.
Well, and what we're doing is, if I don't think I can draw on this chart, but if we drew straight lines across the bottom and the top of this one section here, what we're doing is we're buying in the danger zone. Yeah, like when we're buying, it's a strategic point, and we're either going to be right or wrong, which is different between asset allocation. Asset allocation, that idea that we're going to throw 20 things out there. It's never our fault that way, but we're literally making a decision at the danger zone. It could be a stage 3 that looks like a 1. And if it breaks down, we're not going to wait and see. We're getting out of that thing because we were wrong. And so that's a lot different than asset allocation.
Yeah, that was a paradigm shift for me.
Yeah, that we can risk 1,000 when we have 100,000 in the market, but we are not just hoping that this thing goes well. And so the thing that we can do then is we can take a portion of your allocation and put it in assets that we have a greater expectation, assets that people would say that's a risky investment.
Right.
We can do that because those risky investments sometimes run really fast. And we know that if we put that in there, that we're not taking $100,000 of risk in that risky investment. We're just taking our measured amount of risk because we think at this point in the danger zone, it's a worthwhile risk.
Our industry talks about risk tolerance, and there's even it's a fantastic company. They serve financial advisors and they give you risk scores like A, B, C, D, but it really doesn't tell you anything about portfolio management. All it does is says, okay, you need to have 60% of your money in stocks, 30% in bonds, 10% in cash. And so that really doesn't do anything to protect you on the downside, because all of those asset classes, except for maybe the cash, have significant risk to them.
Right. They when I got in the business, there were types of investments. They called them widows and orphans holdings, or Stan mentioned a one decision kind of thing. Some of you have had some success with the FANG stocks, or the Amazon, the Apple, those things. And sometimes you're lured into a false sense of security in those. And unfortunately, in my career, I've seen a time when utility stocks, which were the original widows and orphans things, have just traumatized people by how poorly they performed. Indianapolis Power and Light was one of those ones that lost 95% of its value in the early 2000s. So we're not putting the whole thing at risk. We have a amount of risk every investment we do that we're looking at to make the decision on your behalf. And so with position sizing versus asset allocation, this is a pretty standard kind of allocation where a portfolio would have 60% in stocks, 30% in bonds, and 10% maybe in the money market is pretty ordinary. A lot of mutual fund companies are, they call these target date funds, where they're kind of targeting a certain allocation. I think even some of those, they even put more in bonds as you get older in time.
Yeah, what was the rule? 100 minus your age, just how many percent you should have in equities, or something.
Probably is
something like that.
Yeah,
that's what I was taught.
Yeah.
And that was to give you protection. Supposedly, that was the risk protection idea. Whereas again, we're just talking about math, like percentages. What are you willing to risk?
And frankly, we're willing to risk zero if the risk isn't worth it. So we would be 100% in that green cash thing from time to time when it appears to us that either having money in stocks or bonds is not worth risking your capital. Like when bonds were paying 3%, we just never owned bonds for anybody.
Well, and you keep track of the stocks that are trading above their 200-day moving average. I know I do too. And when the majority are just not doing well, it makes sense to have a little more cash instead of hoping for a turnaround.
Yeah, I'll share this screen with everybody. This is a spreadsheet I update on a regular basis. And so I didn't update the date here. So I updated this on last Sunday, and the yellow is when the majority of the stocks are trading below a particular moving average. So the 21 day is the shorter term moving average, what's going on with stocks in general in the short term. The 50 days a little longer, and then the 200 day gives you a longer term perspective. And you can see for most of this year, I highlighted in yellow when more than half are trading below that average. And so most of this year, most of the stocks were trending downward. So you don't generally want to be in a lot of stage 4 stocks, and that could be in mutual funds, exchange traded funds, or whatever. And so that just gives me a gut feeling of where we are in the game and whether it's worth taking risk. And so as we're doing position sizing on your benefit, our allocation of between stocks, bonds, and cash, it's going to swing a lot more broadly than what a traditional asset allocator will be. Their percentages are going to be very similar almost all the time. Mm-hmm. And here's an example of position sizing that is what we're constantly considering as we're looking at things on your behalf. So right here, I think this is the S&P 500 earlier. I think this was this year. So it's kind of acting like it's trying to do a stage 3 or 4 over here, and then it rallied a little bit, and we didn't know.
I loved that one.
Yeah,
That was great to see.
we didn't know what was going to happen, right?
Yeah.
Like this was last fall, I think, where it acted like 308 on this was the bottom.
Yeah.
And then when we moved forward to like the first quarter this year, it said, no, we are in a stage 4 right here.
Is that the rally?
Yeah, this is the same thing over here. We just added the later parts of the year.
One of the things I just love about that we'll go back into history and we'll pull up a specific day. And then we'll press our space bar and that forwards the chart out one more day or one more week. And I try and guess what I think is going to happen next, even though I've lived it by now. But this is just a great thing to do because it helps you see, all right, I can't get too emotionally involved here. These prices are going to do something. And when they go below our moving averages, that's just data, that inputs that tell us, hey, it's time to make a decision.
And if we were where I was drawing the line just on that wave earlier, if we just drew a line below 308 right here and said, if it drops below this 308, we might be going into, we're maybe in a stage 3 here. We might be going into a stage 4 below that 308. And that 308 just is like a waterfall down from there. And so if we were doing traditional asset allocating, we wouldn't have done anything there, and we would have just called you and said, "Hey, just hold on, it'll be okay."
Hang in there.
Yeah.
And there are times where, hey, let's face it, on a V-up recovery, when it comes back up just as fast as it went down, that works for a lot of people. They didn't even see a blip in their statement from month to month.
Right.
But these V-up recoveries, like we've experienced here recently and in 2020. Those are very rare. A V-up recovery, my people tell me that happens like 70 or 30% of the time.
Right.
And so to have that type of bounce back up like we have here recently tells me there's a lot of news-driven data. It's not necessarily market force data that's causing prices to come back up quickly.
And so when we're looking at this and we're making decisions versus our friends that do asset allocation, it gives a lot of room for second guess. And the Monday morning quarterbacks could say, "Hey, Doug, why did you do this?" Or "Keith, why did you make that decision?" And that's kind of what this particular week conversation is about, is explaining to you why we made the decision for the next decision we make. And so let's take another gander here. So position sizing what we assume is all investments are bad.
What you and I assume.
Yeah.
Yes.
Until we're proven otherwise.
Yes.
So when we make a decision to buy something for you, we're kind of assuming we're going to be wrong. And so
isn't that a weird thing to think about? Like, I've been taught, hey, investments work. They just go up over time.
Right.
But to flip the script and say, nah, it's got to prove itself. It's got to work its way off my what list.
Yeah.
I mean, it's just a different way of thinking about things.
And this is Caleb. Could you look and tell me what this peak is on this chart here for me? So I don't see the date down here. But this is the 20-year treasury. So if we were doing asset allocations and we put bonds in your portfolio, you guys are brand new at this training here. I would assume you could tell us what stage this 20-year treasury ETF is in here. It looks like a solid stage 4, right?
Yeah.
It dropped from 180 to down about 90. So your bond would have dropped in half.
That's a good time to ski down something that looks like that. Take a vacation.
What year did that peak happen, Caleb?
March 3rd.
So that's 5 years ago. And we've been holding those. What we did instead of these is we held the money market, because the money market held flat and you didn't lose capital on your bonds.
And every asset allocator on the planet, a large percentage of financial advisors would tell you, do not have money in cash.
Right. And part of the reason I think I'm so strongly convicted of this is this trend to the left here. We had almost a 40-year period of time where interest rates were declining and bond rates are teeter-totter, or bonds are teeter-totter. So
They did okay.
if interest rates drop, then it's going to push your bond values up. Well, we've been in a rising interest rate market since 2020. And so to just have that in there and then keep with traditional asset allocating, it would have put more money in this. And so you would have been averaging down, which again is not something we're inclined to do because we don't know what the bottom is. And that's kind of a big deal. And so I think this slide wraps up kind of the idea of this, Doug.
This might be stage 1, 2, 3, 4 is my favorite slide, but I like this slide a lot.
Yeah. So what these are just two different charts of a different stage of something, and then it's overlaid on your age. So if you happen to get into a stage 2 like this in your 60s, 70s, and 80s, you would say, why shouldn't I asset allocate? Why shouldn't I just buy and hold? However, if 1929 was when you turned 60 and we're going into a decade-long stage 4, one of the worst ever in U.S. history, or 1972, 73, or 2000 was another one. 2000 was a 10-year period that dropped down flat. If you happen to be there, it's going to change the whole outlook of your golden years. And it's kind of a big deal. So far, in the last 20 years, well, since we got through the debacle of the 2000 down market that went on till basically 2010, since we got through that, you've been kind of redeemed and given the stage 2 rallies to kind of belly out. We're just managing your resources in a way that we're not assuming you're going to get bailed out. We're managing them, assuming we don't know what the future is, and it could end with either one of these charts, but we don't want to be apologizing to you because we just kept buying more and more as we're sliding down the stage 4.
Yeah, your money doesn't know how.
It does not. You do. You and I do. But the money doesn't have an opinion on it, and it's not going to redeem you just because you need the money at this point in time. So anyway, I thought that would be a great help to our friends that maybe haven't understood what was going on inside the black box and why we're not necessarily scattering money in all the style boxes like some of our friends. But anything else you think we should add to this, Doug?
No, that was fun. Hope you all had fun too.
Well, we appreciate you taking time hanging out with us. We appreciate you trusting us to do business with us. And we plan on being back next time. And in the meantime, you guys enjoy your weekend.